This video is sponsored by Unstoppable Domain. Replace crypto addresses with an easy readable domain name to send and receive crypto. To know more about Unstoppable, please check the link below. Welcome to Add On Crypto. If you're interested in everything about crypto, this channel is for you. Please subscribe and hit the like button for us to provide you with more crypto content.
What is Bitcoin? Bitcoin, BTC, is a cryptocurrency, a virtual currency designed to act as money and a form of payment outside the control of any one person, group, or entity, thus removing the need for third-party involvement in financial transactions. It is rewarded to blockchain miners for the work done to verify transactions and can be purchased on several exchanges. Bitcoin was introduced to the public in 2009 by an anonymous developer or group of developers using the name Satoshi Nakamoto. It has since become the most well-known cryptocurrency in the world. Its popularity has inspired the development of many other cryptocurrencies. These competitors either attempt to replace it as a payment system or are used as utility or security tokens in other blockchains and emerging financial technologies. Learn more about the cryptocurrency that started it all, the history behind it, how it works, how to get it, and what it can be used for. Key takeaways. Launched in 2009, Bitcoin is the world's largest cryptocurrency by market capitalization. Unlike fiat currency, Bitcoin is created, distributed, traded, and stored using a decentralized ledger system known as a blockchain. Bitcoin and its ledger are secured by proof of work, POW, consensus, which is also the mining process that introduces new Bitcoins into the system. Bitcoin can be purchased via various cryptocurrency exchanges. Bitcoin's history as a store of value has been turbulent. It has gone through several boom and bust cycles over its relatively short lifespan. As the first decentralized virtual currency to meet widespread popularity and success, Bitcoin has inspired a host of other cryptocurrencies in its wake. Understanding Bitcoin. In August 2008, the domain name bitcoin.org was registered. Today, at least, this domain is WhoisGuard protected, meaning the identity of the person who registered it is not public information. In October 2008, a person or group using the false name Satoshi Nakamoto announced the cryptography mailing list at metsdao.com. I've been working on a new electronic cash system that's fully peer-to-peer, with no trusted third party. This now famous white paper published on bitcoin.org, entitled Bitcoin, a peer-to-peer electronic cash system, would become the Magna Carta for how Bitcoin operates today. On January 3, 2009, the first Bitcoin block was mined, Block 0. This is also known as the Genesis block and contains the text, "The Times January 3, 2009 Chancellor on brink of second bailout for banks," perhaps proof that the block was mined on or after that date, and maybe also as relevant political commentary. Bitcoin rewards are halved every 210,000 blocks. For example, the block reward was 50 new Bitcoins in 2009. On May 11, 2020, the third halving occurred, bringing the reward for each block discovery down to 6.25 Bitcoins. 1 Bitcoin is divisible to 8 decimal places, 100 millionths of 1 Bitcoin, and this smallest unit is referred to as a Satoshi. If necessary, and if the participating miners accept the change, Bitcoin could eventually be made divisible to even more decimal places. Bitcoin, as a form of digital currency, isn't too complicated to understand. For example, if you own a Bitcoin, you can use your cryptocurrency wallet to send smaller portions of that Bitcoin as payment for goods or services. However, it becomes very complex when you try to understand how it works. Bitcoin's blockchain technology. Cryptocurrencies are part of a blockchain and the network required to power it. A blockchain is a distributed ledger, a shared database that stores data. Data within the blockchain is secured by encryption methods. When a transaction takes place on the blockchain, information from the previous block is copied to a new block with the new data, encrypted, and the transaction is verified by validators, called miners, in the network. When a transaction is verified, a new block is opened, and a Bitcoin is created and given as a reward to the miners who verified the data within the block. They are then free to use it, hold it, or sell it. Bitcoin uses the SHA-256 hashing algorithm to encrypt the data stored in the blocks on the blockchain. Simply put, transaction data stored in a block is encrypted into a 256-bit hexadecimal number. That number contains all of the transaction data and information linked to the blocks before that block. Transactions are placed into a queue to be validated by miners within the network. Miners in the Bitcoin blockchain network all attempt to verify the same transaction simultaneously. The mining software and hardware work to solve the nonce, a 4-byte number included in the block header that miners are attempting to solve. The block header is hashed, or randomly regenerated by a miner repeatedly until it meets a target number specified by the blockchain. The block header is solved, and a new block is created for more transactions to be encrypted and verified. How to mine Bitcoin. A variety of hardware and software can be used to mine Bitcoin. When Bitcoin was first released, it was possible to mine it competitively on a personal computer. However, as it became more popular, more miners joined the network, which lowered the chances of being the one to solve the hash. You can still use your personal computer as a miner if it has newer hardware, but the chances of solving a hash individually are minuscule. This is because you're competing with a network of miners that generate around 220 quintillion hashes, 220 exahashes, per second. Machines, called application-specific integrated circuits, ASICs, have been built specifically for mining, can generate around 255 trillion hashes per second. In contrast, a computer with the latest hardware hashes around 100 megahashes per second, 100 million. To successfully become a Bitcoin miner, you have several options. You can use your existing personal computer to use mining software compatible with Bitcoin and join a mining pool. Mining pools are groups of miners that combine their computational power to compete with the large ASIC mining farms. If you have the financial means, you could also purchase an ASIC miner. You can generally find a new one for around $20,000, but used ones are also sold by miners as they upgrade their systems. There are some significant costs such as electricity and cooling to consider if you purchase one or more ASICs. There are several mining programs to choose from and many pools you can join. Two of the most well-known programs are CG Miner and Miner. When choosing a pool, it's important to make sure you find out how they pay out rewards, what any fees might be, and read some mining pool reviews. How do you buy Bitcoin? If you don't want to mine Bitcoin, it can be bought using a cryptocurrency exchange. Most people will not be able to purchase an entire BTC because of its price, but you can buy portions of BTC on these exchanges in fiat currency like US dollars. For example, you can buy Bitcoin on Coinbase by creating an account and funding it. You can fund your account using your bank account, credit card, or debit card. The following video explains more about buying Bitcoin. How is Bitcoin used? Bitcoin was initially designed and released as a peer-to-peer payment method. However, its use cases are growing due to its increasing value and competition from other blockchains and cryptocurrencies. Payment. To use your Bitcoin, you need to have a cryptocurrency wallet. Wallets hold the private keys to the Bitcoin you own, which need to be entered when you're conducting a transaction. Bitcoin is accepted as a means of payment for goods and services at many merchants, retailers, and stores. Brick-and-mortar stores that accept cryptocurrencies will generally display a sign that says Bitcoin accepted here. The transactions can be handled with the requisite hardware terminal or wallet address through QR codes and touchscreen apps. An online business can easily accept Bitcoin by adding this payment option to its other online payment options, credit cards, PayPal, etc. Investing and speculating. Investors and speculators became interested in Bitcoin as it grew in popularity. Between 2009 and 2017, cryptocurrency exchanges emerged that facilitated Bitcoin sales and purchases. Prices began to rise, and demand slowly grew until 2017, when its price broke $1,000. Many people believed Bitcoin prices would keep climbing and began buying them to hold. Traders began using cryptocurrency exchanges to make short-term trades, and the market took off. In 2022, Bitcoin's price came crashing down. In March 2022, it was as high as $47,454, and as of November 2022, it is $15,731. The drop in Bitcoin is partly due to larger market turmoil related to inflation, rising interest rates, supply chain issues from COVID, and the war in Ukraine. Additionally, some important tokens have crashed in the crypto world, as well as one of the important exchanges, which has raised concerns about the stability of digital currencies. Risks of investing in Bitcoin. Speculative investors have been drawn to Bitcoin after its rapid price appreciation in recent years. Bitcoin had a price of $7,167.52 on December 31, 2019, and a year later, it had appreciated more than 300% to $28,984.98. It continued to surge in the first half of 2021, trading at a record high of $68,990 in November 2021. It then fell over the next few months to hover around $40,000. As mentioned above, in early 2022, the price started to drop and has continued to do so for most of 2022. Thus, many people purchase Bitcoin for its investment value rather than its ability to act as a medium of exchange. However, the lack of guaranteed value and its digital nature means its purchase and use carry several inherent risks. For example, many investor alerts have been issued by the Securities and Exchange Commission, SEC, the Financial Industry Regulatory Authority, FINRA, and the Consumer Financial Protection Bureau, CFPB, regarding Bitcoin investing. Regulatory risk: the lack of uniform regulations about Bitcoin and other virtual currencies raises questions over their longevity, liquidity, and universality. Security risk: most individuals who own and use Bitcoin have not acquired their tokens through mining operations. Rather, they buy and sell Bitcoin and other digital currencies on popular online markets, known as cryptocurrency exchanges. Bitcoin exchanges are entirely digital and, as with any virtual system, are at risk from hackers, malware, and operational glitches. Insurance risk: Bitcoin and cryptocurrencies are not insured through the Securities Investor Protection Corporation, SIPC, or the Federal Deposit Insurance Corporation, FDIC. Some exchanges provide insurance through third parties. In 2019, prime dealer and trading platforms Fox announced it would be able to offer Bitcoin investors FDIC insurance, but only for the portion of transactions involving cash. Fraud risk: even with the security measures inherent within a blockchain, there are still opportunities for fraudulent activity. For instance, in July 2013, the SEC brought legal action against an operator of a Bitcoin-related Ponzi scheme. Market risk: as with any investment, Bitcoin values can fluctuate. Indeed, the value of the currency has seen wild swings in price over its short existence. Subject to high volume buying and selling on exchanges, it is highly sensitive to any newsworthy events. According to the CFPB, the price of Bitcoin fell by 61% in a single day in 2013, while the one-day price drop record in 2014 was as big as 80%. Regulating Bitcoin: like with any new technology, the attempts at regulating Bitcoin have been difficult. The current Biden administration seeks to impose regulations around Bitcoin, but at the same time walks a tightrope in trying not to throttle a growing and economically beneficial industry. Biden has stated he will seek to prevent the illegal use of Bitcoin but also support its development. The US has particularly been focused on regulating crypto and its criminal usage overseas, such as sanctioning cryptocurrency exchanges and individual cryptocurrency wallets and recovering crypto payments made to criminals. There have also been calls for the US to develop a central bank digital currency, CBDC, to appropriately direct these sanctions. As the Bitcoin and cryptocurrency world is emerging, so will the regulation, which will see many changes and laws over time. How long does it take to mine one Bitcoin? It takes an average of 10 minutes for the mining network to validate a block and create the reward. The Bitcoin reward is 6.25 BTC per block. This works out to be about 100 seconds for one BTC to be mined. Is Bitcoin a good investment? Bitcoin has a short investing history filled with very volatile prices. Whether it is a good investment depends on your financial profile, investing portfolio, risk tolerance, and investing goals. You should always consult a financial professional for advice before investing in cryptocurrency to ensure it is right for your circumstances. How does Bitcoin make money? The Bitcoin network of miners makes money from Bitcoin by successfully validating blocks and being rewarded. Bitcoins are exchangeable for fiat currency via cryptocurrency exchanges and can be used to make purchases from merchants and retailers that accept them. Investors and speculators can make money from buying and selling Bitcoins. The following statements do not constitute investment advice or any other advice on financial services, financial instruments, financial products, or digital assets. They are intended to provide general information. The following statements do not constitute an offer to conclude a contract for the purchase or sale of financial instruments and financial products or an invitation to submit such an offer and to buy or sell any particular digital asset. Cryptocurrencies are subject to high fluctuations in value. A decline in value or a complete loss are possible at any time. The loss of access to data and passwords can also lead to a complete loss.
Bitcoin cryptocurrency is a type of money that is virtual. In simple terms, it is a computer program that enables people to exchange the value of money directly with each other. Bitcoin is the first cryptographic commodity, a blockchain, that can be exchanged like cash protected through cryptocurrencies. Trading in Bitcoins is anonymous without any intervention from brokers and intermediaries. Working of Bitcoin. The underlying technology of Bitcoin is blockchain, which is a type of digital ledger. Since it is digital money, you don't physically own it like cash. You own it through the means of a private key. The private key enables you to use Bitcoin, hence, make sure you store the private key in a safe place. In short, you own Bitcoin in the form of possessing a set of unique private keys. Further, Bitcoin does not undergo printing of bills or mining of coins. It is completely autonomous. It is not under the control of any financial institution, bank, or jurisdiction. Moreover, because of its anonymity, no transaction details or users' details are recorded. Transactions are formed through a process called Bitcoin mining. In simple terms, mining is an extraction method. In this extraction method, computational algorithms become a part of a challenging mathematical puzzle. So when one puzzle is solved, one mining block is mined and the user or programmer receives a reward. That reward is a Bitcoin. To collect the Bitcoins users mine, the user has to create a Bitcoin account, which is somewhat like a computer email having 27 to 34 letters and words. Where to buy Bitcoin? Bitcoins or other cryptocurrencies are available on marketplaces known as cryptocurrency exchanges. These exchange platforms can help you to buy and sell Bitcoins. Some popular cryptocurrency exchange platforms are Coinbase, CoinMama, etc. It is stored in a digital wallet, just like a virtual bank account. Why buy Bitcoin? Bitcoin is the largest cryptocurrency in the world. More and more companies are accepting Bitcoin as payment to foster a crypto-driven world. In the future, we might see a world where Bitcoin will be the standard digital money. Any risks? The crypto market is highly volatile. Hence, Bitcoin is subject to market turmoil. Besides that, the lack of transparency and regulation has made the legislation of countries seriously think about cryptocurrency. Further, the mining of Bitcoin has adverse environmental impacts. Hence, Tesla discontinued accepting Bitcoin as payment. Though it is still considering this decision if Bitcoin can work on sustainability concerns. If you wish to invest in Bitcoin, read this guide to know about the crypto market. 10 things you didn't know about Bitcoin. 1. The mysterious creator. In 2009, a person or a group of people known as Satoshi Nakamoto introduced Bitcoin to the world. He, or they, vanished off the internet in late 2010, and he hasn't been heard from since. Just as his identity is shrouded in mystery, nobody really knows if he's even alive or dead. The only communication people had with him was through emails and forums. His Bitcoin wallet holds around 980,000 Bitcoins, which makes him one of the richest people on the planet. 1. The mysterious creator. In 2009, a person or a group of people known as Satoshi Nakamoto introduced Bitcoin to the world. He, or they, vanished off the internet in late 2010, and he hasn't been heard from since. Just as his identity is shrouded in mystery, nobody really knows if he's even alive or dead. The only communication people had with him was through emails and forums. His Bitcoin wallet holds around 980,000 Bitcoins, which makes him one of the richest people on the planet. 3. Losing Bitcoins. Losing your Bitcoin address, which is also known as your private key, not only means losing your unique identification, it also means losing all the Bitcoins in your wallet. Research shows that at least 60% of all Bitcoin addresses are ghosts, which means a huge chunk of the people using Bitcoins have lost their addresses and have no way to access their wallets. 4. Liberland. In April 2015, a micronation between Croatia and Serbia known as Liberland was born. It was founded by Vít Jedlička, a politician, publicist, activist and president of Liberland. The official currency of Liberland is Bitcoin. The government believes that Bitcoin and its underlying concepts of blockchain provide a secure and transparent method for recording electronic, financial, and physical assets. 5. Processing power. The process of mining Bitcoins is expensive. You pay a lot in money, time, and electricity. Mining Bitcoins requires servers used for that specific purpose. The faster you process the data, the faster the block can be added to the blockchain, and the faster you're rewarded with Bitcoins. 6. Power consumption. Ireland consumes approximately 5,000 kilowatt hours of electricity each year. All the Bitcoin mining farms together consume about 60 terawatt hours of electricity, which is approximately 6 by 1,010 kilowatt hours, a large amount of power. The entire country of Ireland, which is the second most populated city in Europe and has 84,421 square kilometers of area, consumes less electricity than all these farms combined. 7. Bitcoin ban. Although several countries around the world, such as Canada and America, have wholeheartedly accepted Bitcoin, some haven't. Countries including Bolivia, Iceland, Bangladesh, and Ecuador have completely banned the usage of Bitcoins. There are also countries, including India, Thailand, and Iran, that have asked their residents to be careful while using cryptocurrencies but haven't completely banned it. However, they do not accept it as legal tender. 8. Limited number of Bitcoins. There's a limit to how many bitcoins can exist in the market, 21 million. As of this moment, 17 million bitcoins are already in circulation. That means almost 80% of the 21 million have already been mined. But don't worry, until 2140, we will still have bitcoins to mine. This is because of how miners are rewarded. Miners are rewarded with 12.5 bitcoins for each block added to the blockchain, and every 4 years the reward is reduced by half. The next halving is supposed to occur in 2020 when the reward will be reduced to 6.25 bitcoins. 9. The power of B. The terms Bitcoin with an uppercase B and Bitcoin with a lowercase b mean two different things. The latter, Bitcoin, refers to the cryptocurrency that is used to perform the transactions. The former, Bitcoin, refers to the ledger that stores information regarding these transactions. 10. Faster than supercomputers. The world's fastest supercomputer, the Summit, works at 122.3 petaflops, which is a quadrillion floating point operations per second. If you look at the entire Bitcoin network, the processing power is about 80,704,290 petaflops. But a supercomputer can do several different things, while the only thing the Bitcoin network does is add blocks to the blockchain. 1. Don't put in more than you can afford to lose. Crypto is riskier than many other investments. Nothing is guaranteed other than volatility. What's more, it's unregulated in most cases. There is no FDIC insurance for this stuff, nor is there a buyer of last resort. The prices of crypto coins swing wildly from minute to minute. While the market is basking in the glow of bull run, it has endured painful and protracted corrections and almost certainly will again. Danger varies in degree. Bitcoin, the original cryptocurrency, has been around for more than a decade and it's significantly less likely to disappear than most other coins. But it's not free of risk either. Hence, don't bet the proverbial farm, or your life savings, on any coin. 2. Research thoroughly. Before you invest a significant amount of money in any digital currency, spend hours upon hours researching the technology so you understand the value proposition and the risks. Someone else will buy it from you for a higher price is not a value proposition. Read everything you can find on the topic. CoinDesk's Learn section is a fine place to start. Lurk on community forums and developer mailing lists. Listen to podcasts. Borrow books from the library, not only about digital currency but related fields like cryptography, game theory and economics. Read CoinDesk and even some of our competitors. 3. Resist fear of missing out. If the only reason you're investing in something is to avoid missing out, the only thing you won't miss out on is losing everything. Fear of missing out, FOMO, is a sure way to destroy whatever wealth you may have accumulated over the years. The problem is that it's a gut reaction to something that should be researched first. Trading based on your gut will quickly lead to an upset stomach. Know what you're buying. Really know it. Going on a trading app and seeing a currency is up 30% or so over the past 24 hours isn't research. It could be you or the unlucky sap being sold a falling cryptocurrency. Every coin has pumpers, shameless promoters, even Bitcoin. Don't succumb to peer pressure. This isn't high school. Think for yourself and evaluate the case for an investment on the merits. Research. Then research again. 4. If it sounds too good to be true, it probably is. Much like Wall Street, the US Congress or the American Bar Association, crypto is rife with charlatans. There are more than enough people promising their project will be the one to overtake Bitcoin. But is it? There's only one way to find out: research. Buyer beware, but also borrower beware. Some crypto exchanges offer more than 100x leverage, meaning you can borrow up to 99% of the cost of an investment. This will juice your profits if a coin goes up in value, but if it goes the other way you could quickly be wiped out. 5. Don't trust, verify. Scammers abound in this market. Just this past weekend, some rascals on Twitter took advantage of Elon Musk's appearance on television's Saturday Night Live to defraud people out of $100,000 worth of various cryptos with a bogus giveaway. Impersonating the comedy show's Twitter account, the miscreants instructed their victims to send small amounts of crypto to verify their addresses. If they did so, they would get 10 times the amount back. That too good to be true proposition was a red flag. Read this and this for more telltale signs. 6. Beware of unit bias. Just because a coin is trading around $1 does not mean it's cheaper than Bitcoin at $58,000. Not all coins are created equal. There are literally thousands of cryptocurrencies, some of which seek to emulate Bitcoin and some of which try to solve other issues. They all have varying levels of developer support and decentralization. Determining the value of a coin means asking how and why was the coin created. What is its supposed utility? Who is working on it? How big is the developer community? How active is the repository on GitHub, where updates to the open source software are usually logged? Like a building, a code base requires maintenance, and neglect can leave a structure unsound. Crucially, what is the coin's security model? Proof of work, proof of stake, or something else? If it's the former, how does the hash rate compare to other POW coins? If you don't know what these terms mean, you're not ready to invest. 7. Not your keys, not your coins. Cryptocurrency is a bearer asset like cash or jewelry, meaning the holder is presumed to be the rightful owner. Once it's lost or stolen, it's gone. That is why advanced users will advise you not to entrust the cryptographic keys to a digital currency wallet to a third party, such as an exchange, because these firms are largely unregulated in many places and may be subject to hacks or exit scams, absconding with clients' money. Decentralized finance, DeFi, platforms have fallen prey to numerous high-profile exploits, and centralized platforms like Binance have been subject to their fair share as well. However, safeguarding keys yourself, on a hardware device or even a piece of paper with a string of numbers and letters written on it, can be a nerve-wracking business, and it's easy to mess up. This is why even some experienced investors prefer to use third-party custodians. Crypto is all about trade-offs. Do you trust yourself not to lose that piece of paper or forget the seed phrase, a password for a key that unlocks your crypto? If not, you have to be comfortable with someone else storing your digital valuables, and history gives you every reason not to. To mitigate the risks, there is something called a multi-signature wallet. These can be configured so that, for example, both Bob and Alice must sign off on a transaction to release funds from a wallet, or either Bob or Alice can do so, or three of Bob and Carol and Ted and Alice, and so on. But yes, it's complicated. Aside from exploits, exchanges may block you from withdrawing your funds at any time for a variety of reasons ranging from solvency issues to legal trouble. Even beyond that, some exchanges just don't have the infrastructure necessary to remain up at all times. Coinbase and Robinhood, for example, often go down during periods of market volatility. If you aren't running your own wallet, you can't guarantee you have control over your coins. That said, there are various reasons why you might want to use an exchange, so it's important to check the user agreements and make sure you're protected against different eventualities. 8. You can buy a fraction of a Bitcoin, and most other cryptos. You don't need to buy a whole coin. Bitcoin, for example, is divisible to the 8th decimal. So if you're curious about how this stuff works, you can purchase as little as $10 worth and just play around with it. As billionaire Mark Cuban recently said on television of buying small amounts of Dogecoin, it's a whole lot better than a lottery ticket. Unfortunately, he also encouraged viewers to spend Doge on merchandise without mentioning the tax implications. See below. 9. Understand the tax consequences. This is especially important in the US, for several reasons. First, the Internal Revenue Service, IRS, considers crypto property, not currency, for tax purposes. The upshot is if you buy a coin for $1 and it doubles in value and you spend that extra dollar to buy so much as a pack of chewing gum, you are required to report that capital gain and pay tax on it. There is no de minimis exemption, despite the crypto industry's lobbying efforts. Also, centralized exchanges regularly send account information to the IRS. Sure, crypto isn't as regulated as stocks or banks. However, the federal government is running a massive deficit and it won't think twice about sending in folks with mirrored aviator glasses to visit you to ask about your crypto trades. 10. Buy using dollar cost averaging and don't obsess about price. Go outside. Get some fresh air, exercise and sunshine. Spend time with your family. You can do all that and invest in crypto. The markets will fluctuate from day to day, hour to hour, minute to minute, but any crypto worth a damn, any investment of any kind worth a damn, is a long-term bet. If you want a dopamine hit, go for a run or watch an action movie. What's the best way to invest and not obsess? It's using dollar cost averaging, DCA. Buy a set dollar amount of whatever crypto you like at regular intervals, daily, weekly, monthly, annually. You pick, and don't look at it. If you have a long-term view, you're not going to be pressured to sell or up your position based on short-term movements if you use DCA. The world of cryptocurrencies is constantly evolving, and the world is paying attention. Veteran or intending crypto investors are always on the lookout for important facts about crypto. Cryptocurrencies were in the headlines in 2021, which led to a growing interest in learning how to buy cryptocurrencies and figuring out easy ways to buy and sell Bitcoin in Nigeria. It's no surprise that some investors are hoping to learn more about how digital assets work. But with cryptocurrencies, sometimes the truth can be stranger than fiction. In this article, we'll outline 10 important facts about cryptocurrencies. But first, a disclaimer, no list can possibly be exhaustive. 1. The first commercial Bitcoin transaction was for pizza. A man in Florida paid 10,000 Bitcoins for 2 Papa John's pizzas on May 22, 2010. This was the first Bitcoin payment for goods, and it was worth around $40 at the time. This is widely acknowledged as the first commercial Bitcoin transaction. You'd be a Bitcoin millionaire if you had that many Bitcoins in September 2022. 10,000 Bitcoins are worth more than $190 million in the market. 2. There are more than 18,000 cryptocurrencies in existence. There are over 18,000 digital currencies in circulation as of October 2022. Although not all of them are available on exchanges, some require their own wallets. This includes many altcoins such as USDT, XRP, Solana, SOL, Binance USD, BUSD, and more. There are so many coins and tokens available because it is relatively simple to create and distribute a new cryptocurrency. However, as of October 2022, the top 20 virtual currencies account for approximately 87% of the cryptocurrency market cap. 3. The total amount of Bitcoins is limited. An interesting Bitcoin fact is that the protocol for the Bitcoin network was designed with a limit of 21 million coins in mind. As a result, cryptocurrency miners will eventually be unable to generate any new Bitcoins. Currently, there are 19.15 million Bitcoins in circulation. This leaves a few million Bitcoin to be mined, which is one of the reasons mining is still a popular activity. 4. Nigeria is Africa's largest crypto market. Crypto adoption in Nigeria is increasing at an exponential rate. Due to the constant depreciation of the naira, the country now has more than 50% monthly active adult crypto traders, as many citizens prefer to store their money in digital currencies rather than fiat cash. Even going as far as to purchase airtime from crypto wallets. Despite the Nigerian government's ban on cryptocurrencies in 2021, many Nigerians continue to trade them. According to Merchant Machines data, Nigeria will be at the forefront of global crypto adoption by 2030. 5. Ethereum fees are referred to as gas. When using the Ethereum blockchain to complete transactions, you're required to pay for gas. On the Ethereum network, gas represents the computational effort used to buy and sell Ethereum in Nigeria. Using the network for apps or transactions, even if it's converting another coin to Ether, means you need to pay for gas. Depending on the transaction and traffic on the blockchain, gas fees can feel quite high in some cases. 6. NFTs aren't currencies. Even though they grew in popularity in 2021 and are considered digital assets, NFTs aren't cryptocurrencies. They're tokens that are not used as a medium of exchange. And NFTs can't be divided or replicated. NFTs can be used as alternative investments similar to artwork or collectibles. In fact, that's how some people see them, digital collectibles and artwork that may potentially grow in value. 7. Dogecoin started as a joke. One of the hottest cryptocurrencies in 2021 was Dogecoin, DOGE, as its market capitalization grew, in part due to support from Elon Musk. It recently replaced the Cardano ADA as the 6th largest crypto in the world. However, this cryptocurrency started out as a joke. The idea was that there were so many coins out there, just being introduced. So the creators of Dogecoin invented the cryptocurrency around the image of the surprised-looking Shiba Inu dog. This was a popular meme in 2013 when Dogecoin was introduced. 8. The creator, or creators, of Bitcoin remains anonymous. Bitcoin is widely known to be created by Satoshi Nakamoto, a pseudonym that is not connected to a real person. The author who distributed the protocol paper via a cryptography mailing list remains unknown. There is much speculation about Satoshi Nakamoto's identity, but no one knows who he is. Nobody knows if they're a single person or a group of people. 9. Elon Musk has a lot of pull when it comes to cryptocurrency prices. Elon Musk has contributed to huge swings in cryptocurrency prices in 2021. The market pays attention when he tweets or speaks about cryptocurrencies. At least, his ardent supporters do. Musk has had an impact on the price of Bitcoin, Dogecoin, and the cryptocurrency market as a whole simply by announcing which coins Tesla will accept for car purchases. Some countries ban cryptocurrencies. Not every country allows the use of cryptocurrencies. Some countries, like Turkey, don't allow cryptocurrency payments, while others, like Nigeria, ban cryptocurrency exchanges. It's practically impossible to actually ban the use of cryptocurrencies, even though countries can regulate access to service providers and shut down exchanges. But with one of the world's largest economies coming out against cryptocurrencies, it's hard to say how things will change in the future. Between Dogecoin's cameos on US television and Bitcoin's growing acceptance on Wall Street, cryptocurrency is reaching a wider audience than ever before. Skyrocketing prices are surely tempting to newcomers, but they should be aware of the risks before jumping in. If you just started paying attention to cryptocurrency and are wondering whether to invest, here are 10 things you need to know before buying anything. Even if you're an old pro, you probably know someone who's curious because they heard on TV or at the bar that the price of some coin is surging and they can get rich quickly trading it. Please share this post with him or her.
Cryptocurrencies have the potential to reshape the financial world as we know it, and to question the very existence of traditional financial infrastructure. But what are the pros and cons of cryptocurrencies? How do you decide which one to invest in, or whether to invest at all? 5 advantages of cryptocurrency. While cryptocurrencies are a relatively recent invention, Bitcoin, for example, started up in 2009, they're definitely here to stay, with all their benefits. From prospects of hefty returns to 24/7 trading on ultra-secure, transparent infrastructure, the world of crypto has plenty to offer, if you know how to tap into it. 1. High risk, and the potential for high rewards. There are more than 10,000 cryptocurrencies on the market today, and each one has its own particular quirks. But all cryptocurrencies have a few things in common, like their tendency to experience sudden spikes and drops in value. Prices are driven primarily by the supply of coins from miners and the demand for them by purchasers. And these supply-demand dynamics can result in hefty returns. The price of Ethereum, for example, roughly doubled from July 2021 to December 2021, quite the payday for investors who got on board at the right time. 2. The blockchain technology underlying cryptocurrency is inherently secure. Some of the major benefits of cryptocurrencies aren't linked to the currencies themselves, but to the infrastructure that supports them. That's the blockchain, the decentralized data storage ledger that tracks every transaction undertaken on it. Once you make an entry in the blockchain, it can never be erased. And with the blockchain stored decentrally across multiple computers, no hacker can access the entire chain in one go. Any information stored in it is safe for good. 3. Bye-bye traditional banks, hello to a fairer, more transparent financial system. By and large, our financial system revolves around third-party intermediaries who process transactions. This means that if you make a transaction, you're placing your trust in one or more of these intermediaries, and the recession of the early 2000s made a lot of people wonder if that was a good idea. The blockchain and cryptocurrencies offer an alternative. They can be viewed by anyone, anywhere, so you can take part in the financial markets and make transactions with no intermediaries whatsoever. 4. Crypto trades around the clock. Another advantage that cryptocurrencies have over banks is that the crypto markets are always open. With coins being mined and transactions being recorded around the clock, you don't have to wait for the NYSE, NASDAQ or any other exchange to start trading for the day if you want to buy, sell, or trade crypto. This has made such an impact that regular stock exchanges are looking into the option of trading stocks outside of regular banking hours as well, although that might still be some way off. So, for investors who are on the go 24/7, crypto might be the best way to generate returns outside of normal working hours. 5. Cryptocurrencies could help investors beat inflation. Cryptocurrencies aren't tied to a single currency or economy, so their price reflects global demand rather than, say, national inflation. But what about inflation of cryptocurrencies themselves? As an investor, you can rest easy, for the most part. The number of coins is capped, so the amount available can't spiral out of control, thus, no inflation. Some coins, like Bitcoin, have an overall cap, others, like Ethereum, have an annual cap, but either way, this approach keeps inflation at bay. 5 disadvantages of cryptocurrency. So that's a lot of glitter, but is the outlook for cryptocurrencies really so golden? Let's take a look at some of the drawbacks. Some are easily resolved, others less so, but it always pays to keep them in mind. 1. Understanding cryptocurrency takes time and effort. Cryptocurrencies can take a while to get your head around. If you're not a digital native, the concept of cryptocurrency, let alone the blockchain, can feel anything but second nature. And trying to invest in something you don't really understand is itself a risk. There are plenty of online resources available to help you, including N26's blog series on crypto, but you'll still need to dedicate some time to truly understand the pros and cons of investing in cryptocurrency. 2. Cryptocurrencies can be an extremely volatile investment. While the price of a cryptocurrency can spike to dizzying highs, with associated benefits for investors, they can also crash to terrifying lows just as quickly. So if you're looking to make stable returns, this might not be the best bet. The cryptocurrency market fundamentally thrives on speculation, and its relatively small size makes it more vulnerable to price fluctuations. That in turn can wreak havoc with the value of coins, one of the major disadvantages of cryptocurrency. 3. Cryptocurrencies haven't proven themselves as a long-term investment, yet. While cryptocurrencies have become widely known and are still gaining in popularity, it's worth remembering that they have only been around for just over a decade. The concept only really emerged with the publication of a white paper on Bitcoin in 2008. Stock markets, in contrast, can look back on centuries of history. The London Stock Exchange, for example, was founded in 1801. Gold has been a proven custodian of value for millennia. But cryptocurrencies? Nobody really knows what will happen to cryptocurrencies in the future, and you need to be brave to enter these uncharted waters as an investor. 4. Crypto has serious scalability issues. You could be forgiven for thinking that digital currencies operate at lightning speed, and they do, up to a point. But at a certain level they run into major issues which make it difficult to roll them out on a large scale. Cryptocurrency providers themselves admit this is an issue, with the people behind Ethereum saying that the blockchain has reached certain capacity limitations that slow the rate at which transactions can be processed. This can be a frustrating experience for transaction participants, to say nothing of the potential financial losses it can cause. 5. Crypto newbies are vulnerable to security risks. Cryptocurrencies might not have the risks that come with using central intermediaries, but that doesn't mean they're completely free from security issues. As a crypto owner, you could lose the private key that lets you access your coins, and with it, all your holdings. And then there's hacking, phishing, and all the other attempts to gain control by malicious means. This is something that seasoned investors keep an eye out for, but newer investors are more likely to be vulnerable to these kinds of traps. Bitcoin is a digital currency which operates free of any central control or the oversight of banks or governments. Instead, it relies on peer-to-peer software and cryptography. A public ledger records all Bitcoin transactions and copies are held on servers around the world. Anyone with a spare computer can set up one of these servers, known as a node. Consensus on who owns which coins is reached cryptographically across these nodes rather than relying on a central source of trust like a bank. Every transaction is publicly broadcast to the network and shared from node to node. Every 10 minutes or so these transactions are collected together by miners into a group called a block and added permanently to the blockchain. This is the definitive account book of Bitcoin. In much the same way you would keep traditional coins in a physical wallet, virtual currencies are held in digital wallets and can be accessed from client software or a range of online and hardware tools. Bitcoins can currently be subdivided by 7 decimal places. 1,000th of a Bitcoin is known as a milli and 100 millionth of a Bitcoin is known as a Satoshi. In truth, there is no such thing as a Bitcoin or a wallet, just agreement among the network about ownership of a coin. A private key is used to prove ownership of funds to the network when making a transaction. A person could simply memorize their private key and need nothing else to retrieve or spend their virtual cash, a concept which is known as a brain wallet. Can Bitcoin be converted to cash? Bitcoin can be exchanged for cash just like any asset. There are numerous cryptocurrency exchanges online where people can do this, but transactions can also be carried out in person or over any communications platform, allowing even small businesses to accept Bitcoin. There is no official mechanism built into Bitcoin to convert to another currency. Nothing inherently valuable underpins the Bitcoin network. But this is true for many of the world's most stable national currencies since leaving the gold standard, such as the US dollar and UK pound. What is the purpose of Bitcoin? Bitcoin was created as a way for people to send money over the internet. The digital currency was intended to provide an alternative payment system that would operate free of central control but otherwise be used just like traditional currencies. Are Bitcoins safe? The cryptography behind Bitcoin is based on the SHA-256 algorithm designed by the US National Security Agency. Cracking this is, for all intents and purposes, impossible as there are more possible private keys that would have to be tested, 2,256, than there are atoms in the universe, estimated to be somewhere between 1078 to 1082. There have been several high-profile cases of Bitcoin exchanges being hacked and funds being stolen, but these services invariably stored the digital currency on behalf of customers. What was hacked in these cases was the website and not the Bitcoin network. In theory, if an attacker could control more than half of all the Bitcoin nodes in existence, then they could create a consensus that they owned all Bitcoin, and embed that into the blockchain. But as the number of nodes grows, this becomes less practical. A realistic problem is that Bitcoin operates without any central authority. Because of this, anyone making an error with a transaction on their wallet has no recourse. If you accidentally send Bitcoins to the wrong person or lose your password, there is nobody to turn to. Of course, the eventual arrival of practical quantum computing could break it all. Much cryptography relies on mathematical calculations that are extremely hard for current computers to do, but quantum computers work very differently and may be able to execute them in a fraction of a second. What is Bitcoin mining? Mining is the process that maintains the Bitcoin network and also how new coins are brought into existence. All transactions are publicly broadcast on the network, and miners bundle large collections of transactions together into blocks by completing a cryptographic calculation that's extremely hard to generate but very easy to verify. The first miner to solve the next block broadcasts it to the network, and if proven correct is added to the blockchain. That miner is then rewarded with an amount of newly created Bitcoin. Inherent in the Bitcoin software is a hard limit of 21 million coins. There will never be more than that in existence. The total number of coins will be in circulation by 2140. Roughly every 4 years, the software makes it twice as hard to mine Bitcoin by reducing the size of the rewards. 1082. There have been several high-profile cases of Bitcoin exchanges being hacked and funds being stolen, but these services invariably stored the digital currency on behalf of customers. What was hacked in these cases was the website and not the Bitcoin network. In theory, if an attacker could control more than half of all the Bitcoin nodes in existence, then they could create a consensus that they owned all Bitcoin, and embed that into the blockchain. But as the number of nodes grows, this becomes less practical. A realistic problem is that Bitcoin operates without any central authority. Because of this, anyone making an error with a transaction on their wallet has no recourse. If you accidentally send Bitcoins to the wrong person or lose your password, there is nobody to turn to. Of course, the eventual arrival of practical quantum computing could break it all. Much cryptography relies on mathematical calculations that are extremely hard for current computers to do, but quantum computers work very differently and may be able to execute them in a fraction of a second. What is Bitcoin mining? Mining is the process that maintains the Bitcoin network and also how new coins are brought into existence. All transactions are publicly broadcast on the network, and miners bundle large collections of transactions together into blocks by completing a cryptographic calculation that's extremely hard to generate but very easy to verify. The first miner to solve the next block broadcasts it to the network, and if proven correct is added to the blockchain. That miner is then rewarded with an amount of newly created Bitcoin. Inherent in the Bitcoin software is a hard limit of 21 million coins. There will never be more than that in existence. The total number of coins will be in circulation by 2140. Roughly every 4 years, the software makes it twice as hard to mine Bitcoin by reducing the size of the rewards. When Bitcoin was first launched, it was possible to almost instantaneously mine a coin using even a basic computer. Now it requires rooms full of powerful equipment, often high-end graphics cards that are adept at crunching through the calculations, which when combined with a volatile Bitcoin price can sometimes make mining more expensive than it is worth. Miners also choose which transactions to bundle into a block, so fees of a varying amount are added by the sender as an incentive. Once all coins have been mined, these fees will continue as an incentive for mining to continue. This is needed as it provides the infrastructure of the Bitcoin network. Who invented Bitcoin? In 2008, the domain name .org was bought and an academic white paper titled Bitcoin, a peer-to-peer electronic cash system, was uploaded. It set out the theory and design of a system for a digital currency free of control from any organization or government. The author, going by the name Satoshi Nakamoto, wrote, "The root problem with conventional currencies is all the trust that's required to make it work. The central bank must be trusted not to debase the currency, but the history of fiat currencies is full of breaches of that trust." The following year, the software described in the paper was finished and released publicly, launching the Bitcoin network on January 9, 2009. Nakamoto continued working on the project with various developers until 2010, when he or she withdrew from the project and left it to its own devices. The real identity of Nakamoto has never been revealed, and they have not made any public statement in years. Now the software is open source, meaning that anyone can view, use or contribute to the code for free. Many companies and organizations work to improve the software, including MIT. What are the problems with Bitcoin? There have been several criticisms of Bitcoin, including that the mining system is enormously energy hungry. The University of Cambridge has an online calculator that tracks energy consumption, and at the beginning of 2021 it was estimated to use over 100 terawatt-hours annually. For perspective, in 2016 the United Kingdom used 304 terawatt-hours in total. The cryptocurrency has also been linked to criminality, with critics pointing out to it being a perfect way to make black market transactions. In reality, cash has provided this function for centuries, and the public ledger of Bitcoin may actually be a tool for law enforcement. Bitcoin was created by Satoshi Nakamoto, a pseudonymous person or team who outlined the technology in a 2008 white paper. It's an appealingly simple concept. Bitcoin is digital money that allows for secure peer-to-peer transactions on the internet. Unlike services like Venmo and PayPal, which rely on the traditional financial system for permission to transfer money and on existing debit/credit accounts, Bitcoin is decentralized. Any two people, anywhere in the world, can send Bitcoin to each other without the involvement of a bank, government, or other institution. Every transaction involving Bitcoin is tracked on the blockchain, which is similar to a bank's ledger, or log of customers' funds going in and out of the bank. In simple terms, it's a record of every transaction ever made using Bitcoin. Unlike a bank's ledger, the Bitcoin blockchain is distributed across the entire network. No company, country, or third party is in control of it, and anyone can become part of that network. There will only ever be 21 million Bitcoin. This is digital money that cannot be inflated or manipulated in any way. It isn't necessary to buy an entire Bitcoin, you can buy just a fraction of one if that's all you want or need. It's important to understand there are three separate components to Bitcoin, all of which combine together to create a decentralized payment system. The Bitcoin network. The native cryptocurrency of the Bitcoin network, called Bitcoin, BTC. The Bitcoin blockchain. Bitcoin runs on a peer-to-peer network where users, typically individuals or entities who want to exchange Bitcoin with others on the network, do not require the help of intermediaries to execute and validate transactions. Users can choose to connect their computer directly to this network and download its public ledger in which all the historical Bitcoin transactions are recorded. This public ledger uses a technology known as blockchain, also referred to as distributed ledger technology. Blockchain technology is what allows cryptocurrency transactions to be verified, stored and ordered in an immutable, transparent way. Immutability and transparency are vitally important credentials for a payment system that relies on zero trust. Whenever new transactions are confirmed and added to the ledger, the network updates every user's copy of the ledger to reflect the latest changes. Think of it as an open Google document that updates automatically when anyone with access edits its content. As its name implies, the Bitcoin blockchain is a digital string of chronologically ordered blocks, chunks of code that contain Bitcoin transaction data. However, it is important to mention that validating transactions and Bitcoin mining are separate processes. Mining can still occur whether transactions are added to the blockchain or not. Likewise, an explosion in Bitcoin transactions does not necessarily increase the rate at which miners find new blocks. Irrespective of the volume of transactions waiting to be confirmed, the Bitcoin is programmed to allow new blocks to be added to the blockchain approximately once every 10 minutes. Due to the public nature of the blockchain, all network participants can track and assess Bitcoin transactions in real time. This infrastructure reduces the possibility of an online payment issue known as double spending. Double spending occurs when a user tries to spend the same cryptocurrency twice. Bob, who has one Bitcoin, might try to send it to both Rishi and Eliza at the same time and hope the system doesn't spot it. Double spending is prevented in the traditional banking system because reconciliation is performed by a central authority. It also isn't a problem with physical cash because you can't hand two people the same single dollar bill. Bitcoin, however, has thousands of copies of the same ledger, and so it requires the entire network of users to unanimously agree on the validity of each and every Bitcoin transaction that takes place. This agreement between all parties is what's known as consensus. Just as banks constantly update the balances of their users, everyone that has a copy of the Bitcoin ledger is responsible for confirming and updating the balances of all Bitcoin holders. So, the question is, how does the Bitcoin network ensure that consensus is achieved, even though there are countless copies of the public ledger stored all over the world? This is done through a process known as proof of work. What is proof of work? Computers in the Bitcoin network use a process called proof of work, POW, to validate transactions and secure the network. Proof of work is the Bitcoin blockchain's consensus mechanism. While proof of work was the first and is generally the most common type of consensus mechanism for cryptocurrencies that run on blockchains, there are others, most notably proof of stake, POS, which tends to consume less overall computing power, and therefore less energy. Proof of work elevates certain network contributors to the role of validators, more commonly known as miners, only after they have proven their commitment to the network by dedicating an immense amount of computing power to discovering new blocks, a process that typically takes approximately 10 minutes. When a new block is discovered, the successful miner who found it through the mining process gets to fill it with 1 megabytes worth of validated transactions. This new block is then added to the chain and everyone's copy of the ledger is updated to reflect the new data. In exchange for their efforts, the miner is allowed to keep any fees attached to the transactions they add, plus they're given an amount of newly minted Bitcoin. The new Bitcoin created and handed to successful miners is known as a block reward. All Bitcoin users have to pay a network fee each time they send a transaction, usually based on the size of it, before the payment can be queued for validation. Think of it like buying a stamp to post a letter. The goal when adding a transaction fee is to match or exceed the average fee paid by other network participants so your transaction is processed in a timely manner. Miners have to cover their own electricity and maintenance costs when running their machines all day to validate the Bitcoin network, so they prioritize transactions with the highest fees attached to make the most money possible when filling new blocks. You can view the average fees on the Bitcoin mempool, which can be likened to a waiting room where unconfirmed transactions are held until they are selected and added to the blockchain by miners. Read more: how Bitcoin mining works. How is Bitcoin created? The Bitcoin network automatically releases newly minted Bitcoin to miners when they find and add new blocks to the blockchain. The total supply of Bitcoin has a cap of 21 million coins, meaning once the number of coins in circulation reaches 21 million, the protocol will stop minting new coins. In a way, Bitcoin mining doubles as both the transaction validation and the Bitcoin issuance process. Until all the coins are mined, then it will only function as the transaction validation process. Importantly, increasing the amount of computing power dedicated to Bitcoin mining will not mean more Bitcoins are mined. Miners with more computing power only increase their chances of being rewarded with the next block, so the amount of Bitcoin mined remains relatively stable over time. The Bitcoin network uses a coin distribution strategy known as Bitcoin halving that ensures the amount of Bitcoin distributed to miners reduces over time. By gradually decreasing the supply of new Bitcoin entering circulation, the idea is it will help support the asset's price, based on the fundamental principles of supply and demand. A Bitcoin halving, sometimes called a halvings, happens every 210,000 blocks or roughly 4 years. When the Bitcoin protocol first launched in 2009, each successful miner received 50 Bitcoin, BTC, as a block reward. Fast forward to 2021, block rewards are now 6.25 BTC, a reduction from 12.5 BTC prior to the Bitcoin halving in May 2020. The next halving is expected to take place sometime in 2024 and will see block rewards drop again, to 3.125 BTC. This process will continue until eventually there are no more coins left to be mined. Today, there are over 18.7 million BTC in circulation, meaning there are just 2.25 million BTC left to enter circulation. However, taking into consideration the halving principle and other network factors like mining difficulty, it's estimated the last Bitcoin will be mined sometime around the year 2140. What is a Bitcoin wallet? A Bitcoin wallet is a software program that runs on a computer or a dedicated device that provides the functionality required to secure, send and receive Bitcoin. Counterintuitively, the Bitcoin itself is not stored in a wallet. Instead, the wallet secures the cryptographic keys, essentially a very specialized type of password, that proves the ownership of a specific amount of Bitcoin on the Bitcoin network. Anytime a Bitcoin transaction is executed, ownership of the Bitcoin transfers from the sender to the recipient, with the network designating the recipient's keys as the new password for accessing the Bitcoin. Bitcoin uses a system called public key cryptography, PKC, to preserve the integrity of its blockchain. Originally used to encrypt and decrypt messages, PKC is now commonly used on blockchains to secure transactions. This system allows only individuals with the right set of keys to access specific coins. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.
Thank you for watching, and see you next time on Add on Crypto. Hey, check out BitPay's new card. You can convert crypto to dollars easily. Just get the app, set up a wallet, and order the card using my code that I will be adding in the link description below.